All right, looks like we are at time. So let's go ahead and get started. My name is China Chun and I'm with NACBA and the Consultants Training Institute. Before we start the um, show for you today, I want to go over a few housekeeping items. First, to obtain CPE credit, you must answer all the poll questions that pop up on your screen during today's webinar. Um, if you have any questions during the webinar today, please use the Q&A feature in Zoom, as those will be directed to the presenter. If you have any technical questions or questions about Zoom or NACBA, please feel free to use the chat feature, as those will be directed to me. Let me just advance the slide real quick. It's not letting me do that. Not sure. Um, and then for our editor today, we have Wolfgang Niest and Shah, who have joined us. And then let me just, for some reason, my Zoom, it's not working. Yeah, sorry for technical questions. It's just stuck on that slide. Just real quick, for the GACBA news section, one thing that I do have is we do have our Consultants Training Institute super conference that's happening right now in Fort Lauderdale. Well, it's going to be happening this week on December 14th to the 15th. In the materials, you'll find a link that you can register for the virtual registration if you are in need of CPE and would like to join us. There's also the opportunity to join us with the a la carte session, so you can choose specifically which sessions you want to attend and not have to pay for the whole event if you wanted to. And with that, do a quick introduction for our presenter. Today we have Upasak Shah, who will present on the value of security issued by privately held companies and complex capital structure. Mr. Upasak Shah is the co-founder and director of NonCrap Analytics Private Limited. Mr. Shah has extensive background with 15 plus years experience in providing business valuation and transaction advisory services for companies spanning technology, life sciences, and various other industries. Mr. Shah has performed valuations for hundreds of privately held businesses and a handful of publicly traded companies for a variety of purposes, including mergers and acquisitions, gift and estate taxes, 409A compliance, purchase price allocations, market-to-market for large portfolios, embedded derivatives, intellectual property, complex securities, and goodwill impairment. Mr. Shah has spoken at several webinars for Indian valuation professionals on topics related to business valuation and opportunities for valuation professionals in India, among others. Prior to co-founding NoCraft, he's worked at EXL, where he pioneered transition advisory and complex security valuation services. He has proven expertise in valuing derivatives and embedded securities using complex models, such as lattice or Monte Carlo situations. In 2019, Mr. Shah was nominated for 40 under 40 by NACBA. Mr. Shah holds a Master's of Commerce degree from Gujarat University in India and a Master's of Science degree in Finance from ICFAI University in India. He is the director of Academy of Certified Valuators and Analysts, ACVA, NACBA's India chapter, focused on nurturing business valuation talent in India. Mr. Shah is also an expert member of the Business Valuation Institute in the UK. And with that, I'm going to turn the time over to Upasak, who will get us started for today. Thank you for joining us, Upasak.
Thank you, Chanda, for a nice introduction. Hi, everyone. Good morning and good evening to our friends and colleagues from North America and Europe. It's a pleasure to be presenting the session on valuing securities for privately held companies. I'm hoping my screen is visible with the presentation on it.
Yes, we can see your screen. Thank you.
So today's webinar objectives is to focus on what is a complex capital structure and how do we, which approaches we consider to allocate value among the complex capital structure for privately held companies, and then having a practical example or application on one of the approaches, which is the option pricing method. So we first start with an overview on the complex capital structure. In the traditional world of equity, we had common stock equity and stock options. But in the recent years, as the economy has more progressed, the companies have received financing from venture capitalists and other sophisticated investors. And securities to those investors have been issued in a different form, which is generally called as preferred equity securities, wherein they receive a liquidation preference, and then they have a right to participate along with the common stockholders or convert at an exit if they are in the money. So preferred shares enjoys different rights and preferences, which may or may not be available to common stockholders, such as they may have participation or conversion rights, voting rights, dividends, anti-dilution, redemption rights, and many others. So preferred shares are like a hybrid instrument. They are quasi-debt and quasi-equity. In the sense, they have a liquidation preference which safeguards the principal amount in scenarios where the exits are not in the money. So that has a characteristic of a debt, and then they can convert or participate with other equity holders or common equity holders. That creates an equity-like feature. So in today's presentation, we'll understand how do we allocate value among preferred equity, considering their rights and preferences as prescribed by the standards of AICP and IBSC. There are three different approaches that is mentioned by the regulatory bodies IBSC and AICPA. IBSC stands for International Valuation Standards Council, which is generally relied upon by appraisers in Europe and India. AICPA stands for the American Institute of Certified Public Accountant, and that institute publishes guidance for the appraisers in North America. So both the guidance mention three approaches to allocate the value. The first one is the current value method, second is the option pricing method, and the probability weighted expected return method. Of the three approaches, CVM is basically an approach that assumes a liquidity event on the date of the valuation. So this approach is more appropriate when a company is not a going concern or it's a very early stage when no value is being created. In those kind of scenarios, CVM may be appropriate, but in most cases, appraisers don't rely on a current value method to allocate the value. The P1 basically is a forward-looking approach wherein the appraisers would forecast the potential exits, like an IPO or a change of control event or a failure event that may occur in the future years. This is generally difficult to predict given the uncertainties in the market, the product development, and other factors. So that creates more complexities for the appraiser and bunch of assumptions which are difficult to forecast as of today. Hence, POM is not used a lot in terms of business valuations, but sometimes a part of POM, which is basically an IPO or M&A scenario, may be used along with the approaches. So the third approach, the option pricing method, is the most prominent approach, which is generally used by the valuation community to allocate the value based on the rights and preferences of the shareholders. Recently, we also started using a combination of a POM and an OPM, which is called a hybrid approach, wherein if the company is anticipating a scenario in which it can go public in next couple of years, then we can use an approach in which we use an IPO as one of the scenarios, and for the possible outcomes which are not known as of today, an option pricing method can be used. So combining the two approaches basically becomes a hybrid method, which is used for companies that are planning to go public, but doesn't have a high probability as the markets or the IPO markets are pretty uncertain, and the window is difficult to estimate whether it's open or not for the early stage companies. And even the audit community generally prefers the option pricing method as it is easier to audit, has more scientific approach and less assumptions. So in most cases, we would end up applying or using option pricing method to allocate value among preferred and common equity holders. So what's the underlying premise of an option pricing method? So I think everyone is familiar what an OPM means. OPM basically is valuing a call option or a put option or of a security. So similar logic is applied here, wherein the different classes of equity are considered having an options on the total value of the company. For example, there may be different classes of security, common stock, preferred series A, B, and C. So each class of security has a claim on the company based on the rights and preferences. So each claim is equivalent to a call option and up to the value that they will receive. Thus, each yeah. So therefore each equity class can be valued using each share in the call option. So OPM considers preferred and ordinary shares as a option on total equity value of the company based on their participation thresholds, which accounts for the rights and preferences. So we'll come that in the next upcoming slides when we take a practical example how it is factored in. So which are the OPM models which are generally used? So there are three models we use in the industry: the Black-Scholes, the Lighters, and the Monte Carlo. Black-Scholes is a closed form model which is based on a log normal distribution of the underlying stock price um, for the term of the option. It basically mimics a European option since it cannot model an early exit. This Black-Scholes is generally the most preferred approach in valuing allocating the value of securities, given the characteristics would mimic a Black-Scholes approach. But in some cases, we also do binomial lattice and Monte Carlo. So binomial lattice is an open form model, which has a bit more flexibility than the Black-Scholes model. We can model in different scenarios within a binomial lattice model, like an early exit or a conversion feature, which may be difficult to model in a Black-Scholes model. Binomial basically means constructing an up and down tree based on inputs which are pretty similar to Black-Scholes model, but it's an open form, so we could see each step of the construct from the valuation date until the exit date. In more complex scenarios, we may use Monte Carlo, which basically requires running a large number of simulations using a random number generator that addresses changes in the key variables or assumptions that may impact the payoff to a particular security holder. In Monte Carlo, we can model in different part dependencies, triggers, change of control, etc. on explicit basis, which is not possible to do in Black-Scholes or binomial lattice model. Monte Carlo is generally used to evaluate real options, embedded derivatives, securities with sophisticated terms. In most cases, the venture financing doesn't have such parameters or sophisticated terms, so we don't end up doing Monte Carlo. And most other deals are structured in a standard way, hence we end up in a Black-Scholes model. In some cases, we may also use a lattice model. For example, the liquidation preference to a preferred shareholder may be dependent on the future exit value. For example, the exit value of the company is $100 million, then the liquidation preference may be 1x. But if the exit value increases to $200 million, then the liquidation preference may be 2x of the issue price. In those cases, in which the liquidation preference is dependent on the future exit value and is not linear in its way, we may end up using a binomial lattice model. But those are very rare scenarios. So, as I said earlier, the appraisers would rely primarily on the Black-Scholes model as a part of the OPM framework. Considering it requires limited inputs, which are the 5 standard inputs, it's easier to build and more scientific to do, and it's audit friendly. We'll discuss in detail about the 5 inputs and how do we consider each input in construct of the Black-Scholes model for the option pricing matter. The OPM can also be used to estimate the implied value of the company based on a recent transaction. For example, if the company raised preferred equity at $10 per share, then we can use that as a transaction and estimate what the implied value of the company may be by back solving for the estimated equity value such that the implied value of the preferred security from the Black-Scholes OPM is equal to $10. This is a phenomenon which most appraisers would consider when they value the company based on recent venture financing transaction. The OPM valuation may give a value which can be on a minority or a controlling basis or marketable, non-marketable basis, depending on the input of the company's value or the subject transaction. Hence, the appraiser should consider making additional adjustments like discount for lack of control or discount for lack of marketability in the value concluded from an option pricing matter. So we'll start with which are the key inputs for a Black Scholes OPM. So there are five standard inputs or the key assumptions which we need to estimate before constructing the Black Scholes model. The first is the underlying stock price, which mimics the equity value of the underlying company, which is available for allocation to different equity holders. Then what's the term of the option? That would mean what's the exit term for the investors in that company. Then each investor will have an investment horizon, and we may take a weighted average term. If an investor anticipates an exit from the next 3 to 7 years, we can estimate based on what's the likelihood of an exit within the next 3 years, 4, 5, 6 years, and take a weighted average term. The risk-free rate is based on the country risk or the country's treasury rate or the no default rate of securities. So, for example, if you're valuing a US company, you may look at the US treasury rates for the underlying term as an input for the risk-free rate. Volatility. Volatility is basically the annualized standard deviation of change in the daily stock prices of comparable companies. Basically, it looks on the historical movement in the stock prices and estimate the volatility based on change in movement of the comparable companies. Since we are valuing a privately held entity, its stock is not basically sold in the open markets. Hence, we cannot use that as a benchmark to compute volatility. So we look at the comparable companies. Some appraisers may also look at the implied volatilities, which is based on what the marketplace is implying based on the change in the option prices of a stock. For example, many companies will have stock options that are traded in a major exchange. So based on the movement of stock prices or the option prices, implied volatility can be computed. But since that is for a shorter period and all the companies may not have options traded in the marketplace or may have few options, hence implied volatility not used on a more frequent. It is used only for scenarios in which the term is pretty short and the comparable companies have tradable options in the major stock markets. In the last and key input is the strike price. So strike price here would be a series of call options. So there would be series of strike price, which will be based on the rights and preferences of underlying securities. So we have a detailed discussion on how to determine the strike price. So yeah, strike price means basically determining the waterfall of the equity holders. Each distribution will be incremental value to the previous value. For example, if a company has issued three classes of equity, common equity, Series A and Series B, and Series B is senior to Series A in terms of liquidation preference, and Series A has a higher seniority than common stock, and Series B has liquidation preference of 15 million, Series A had liquidation preference of 10 million. So in those cases, the strike price would be $50 million as the first breakpoint, wherein Series B's claim would be satisfied. Then next breakpoint would be 15 million plus $10 million. So it's incremental in its calculation, and it represents the claim on the company. So Series A will have a claim on a company, B claim is satisfied. So hence it's an incremental value to Series B. What is the tranche value? So tranche value basically means the difference between the value option for two consecutive breakpoints. So In the earlier case, we would compute the value of the call option when Series B receives its liquidation preference and Series A receives a liquidation preference. And difference between the two would be considered as a tranche value that shows the distribution to the security at that point of time based on the right on the or the claim on the company's equity. Allocation of value would be what was proportion of value would be allocated to underlying securities at each breakpoint. And the same would be distributed based on the ownership or the allocation percentage. And then we would sum all the value of at each tranche or all the tranches to compute the per share value of each securities. We'll take a live example here. And let me know if you have any questions and examples. So let's assume a company which was started in 2015 with a capital of $5 million. In 2017, it received Series A preferred equity with a liquidation preference of $15 million at the issue price of $7 per share. Then in 2019, the company received Series B investment of $30 million at the issue price of $9.80, which implies the post-money value of $100 million. I'm assuming everybody's familiar with pre-money and post-money valuation. If not, I'll just take a minute here to explain what does a pre-money and post-money means. So post-money would imply the value of the company after the fundraise. So in this case, when the company raised $30 million as at $9.80, that means the value of all the securities, if it is $9.80, then the company's post-money value would be $100 million, which is sum of the shares for Series B, A, and common stock times $9.80. Then the pre-money would be post-money less invested amount. So Series B pre-money would be $30 million. So in the world of venture financing, that the valuation is determined based on the pre-money value at the time of the transaction. So here the investors would have agreed that the pre-money value would be $70 million. And if they want 30% equity, they would get 3 million shares at $9.80. And the last assumption is Series B is senior to Series A. That means in a scenario, when there's a liquidation event or dissolution event, Series B will get a first right on the company's equity until its liquidation preference is paid. And then Series A will have the claim on the company's equity, and the balance will be distributed to common and other preferred based on the rights and preferences. Now, calculation of breakpoints. So the first breakpoint will be pretty straightforward when in Series B will receive liquidation preference, which is equal to investor capital of $30 million. Series A will be, so second breakpoint would be liquidation preference to Series A, which will be sum of liquidation preference paid to Series A, which is $5 million, plus the previous breakpoint of $30 million. So the total value of the breakpoint will be $35 million. There's a typo in the presentation. This should be $35 million instead of $5 million. Breakpoint 3 would be the catch-up for common stock. Means common stock will receive value equal to Series A LP of $7. So 5 million shares for common stock has been issued. Then times $7 per share. So common stock will receive $35 million until which Series A or B will not receive incremental value. So until the company values $80 million, common stock will receive the difference between $45 million and $80 million. Thereafter, Series A will go catch up to Series B, which means it will receive an incremental value of $2.80. Since Series A has an LP of $7 and Series B has an LP of $9.80. So Series A will catch up until the value of the company is $100 million, which implies that Series A and common stock each receive $9.80, which is equivalent to the issue price or the liquidation preference for Series B. So we'll take an example of how the payoff works for Series B. So the blue shaded graph presents the value allocated to Series B. The first $30 million gets paid to Series B, then until $100 million Series A and common stock will do a catch up. Then the incremental value beyond $100 million would be distributed in the ratio of the ownership between common stock Series A and Series B. So Series B will have a payoff above its liquidation preference when the value of the company is more than $100 million. If the value of the company is below $100 million, then Series B doesn't get any value above $30 million. So this presents the conversion value presents the upside, which the Series B will get if the value of the company exceeds the threshold of $100 million. This is a typical waterfall, assuming if the company was allocating its equity value as of today, then which security will get how much value. So the first 30 million goes to Series B for its liquidation preference. The next $50 million will be paid to Series A for its liquidation preference. Then common equity will do a catch up equal to $7 per share. So it will get 5 million times $7, $35 million. Then Series A and common will catch up for $2.80. So both the securities get incremental $2.80, such that their payoff equals $9.80. And thereafter, the incremental value of $25 million, which is 125 million equity value minus 100 million threshold of Series B, would be paid to common Series B and Series A based on their ownership percentage of the company. So I'll take a pause here. There is a poll. So this step 2 presents the tranche value at each breakpoint. So here we'll do 5 different call options based on 5 different breakpoint values. So the starting value will always be $0. So Series B will receive a value between $0 and $30 million. So since the model won't work at a $0, so we consider a price of 0.001 as a starting threshold price. And then the next breakpoint would be at $30 million. So the difference between $0 to $30 million would be distributed to Series B, which is called a tranche value for Series B, shown in the last row, which is difference of the call option value of $125 million and $100.5 million. Similarly, for Series A, it will receive a value when the value of the company is more than $30 million, but less than $45 million. So the difference between the both the threshold points would be distributed to Series A, which is basically a call option of 100.5 less 89.51. 10.99 is the value of the call option for Series A. Thereafter, in tranche 3, value would be distributed to common equity, wherein the value of the company is between 45 and $80 million. So we do a similar calculation and compute the delta at 21.02 as a value of the tranche. And between 80 to 100, Series A and common stock will see the value, which is equal to $9 million. And beyond 100 million, the value will be distributed to all the securities. So there is no endpoint, hence there is no difference from tranche 5 to tranche 6. The entire value of tranche 5 would be allocated to all the security holders. So now, how do the allocation works? The first 3 tranches are pretty straightforward, since 100% allocation goes to Series B, then Series A, and then common stock equity. In tranche 4, Series A and common stock both will participate. So the Allocation is based on the ownership percentage or the shares that are issued to them. So Series A is 30% ownership and Series Common Stock has 70% ownership on a non-Series B cap table. Hence, the value would be allocated in that ratio. After Series B converts, the allocation would change based on their total shares. So Series B owns 30% of the company and Series A owns 21% of the company on a fully diluted basis. And the allocation would be in that respective ratio. I'll take a hypothetical example. If Series B and Series A were have a same seniority, which means they were pari passu, then in the first break point itself, Series B and Series A would receive the LP, and the allocation would be based on the liquidation preference and not based on the share that they are issued. So whenever we read the certificate of incorporation or the articles of incorporation, it's critical to understand what is the seniority and how the allocation works. It will be mentioned allocation would be based on liquidation preferences or based on number of shares. And accordingly, we need to consider those parameters while determining the allocation percentage among different classes of equity. The step 4 is allocating the tranches based on allocation percentage. So as we discussed in tranche and step 3, in the first 100% goes to Series B. So 24.5 million is distributed to Series B, then Series A, then common stock, and then a common and Series A, then common Series A and Series B. So total equity value of $125 million is distributed across 5 different tranches based on the ownership percentage of each security. Hence, then we basically sum. In the next slide, we will sum up all the value of paid allocated to each security in different tranches and compare total value to each security, which comes to $13.79 for Series B and $11.31 for common stock. So $125 million is distributed in this framework, when common stock will receive a higher value compared to CVM allocation. So I'll take a step back. If we were to do a normal CVM waterfall, then common equity would have received $35 million over here and then $14 million and $12 million under this breakpoint. So the value would have been substantially lower compared to what it would be receiving in an option pricing framework, because there's optionality built in this framework. So there's a future upside that may take place in the company and whose value would be allocated to common stock. Under a CVM approach, there is no optionality built in, and there's no upside for common stock equity holders. And most of the value is concentrated towards the liquidation preferences. So in almost all the scenarios, CVM will undervalue the common stock, whereas OPM will give an appropriate value to a common stock to account for the optionality. I'll take a pause here. Since this is a case study with any questions, I can go to any of the previous slides, explain them in detail. So I don't see any questions as of now.
Yeah, there are no questions on the chat box as well, so you can proceed, and maybe the last 10-15 minutes you'll see some questions coming in.
So we'll also discuss the differences between the 3 option pricing models. So the Black-Scholes has discussed is a closed form model, binding lattice, and Monte Carlo the open form models for option pricing approaches. All the 3 approaches assumes log normal. However, in Monte Carlo simulation, we have the flexibility to build in different distributions. So using different softwares, we can build in a log normal distribution or a normal distribution. We can also do Bernoulli distribution or a triangular distribution. So all the possible distributions are possible to structure in a Monte Carlo simulation, but black squares and lattice will always be a log normal distribution. In terms of complexity, black squares is a pretty low complex model. There are many online tools that are available to value a call option using a BSM. For lattice, again, there are models available online to build a lattice model. However, if we were to build a different assumptions, like an early exit or a conversion, in those cases, the complexity is pretty high. Monte Carlo simulation in that way is pretty complex to build, given the different part dependencies and triggers we need to build it. In the world of fair value reporting, uh, appraisers will use a lattice model to value conversion features for a convertible debt or liquidation preferences that are based on the future value of the companies or other conditions. Monte Carlo simulations are generally used for real options. They are also used to value embedded derivatives, wherein the value of the derivative is dependent on the different exit or different events. For example, a value of a derivative would be different if the company raises a qualified financing versus non-qualified financing, or there's a change of control before a certain event, or if a covenant is not met, then the bond value would be different. Or the strike price of the bond is not known as a valuation rate and is dependent on the future performance of the stock price. So all the different triggers and part dependencies can be built in Monte Carlo, which makes it complex, but those are used in those scenarios which are different modalities built in terms of assumptions for underlying security. Blackquick can only value European option because there's no way we could model early exit. Binomial and Monte Carlo, we have an option to build in an early exit. Hence, both American European options can be valued using binomial and Monte Carlo simulation. In terms of black squares, there is no flexibility because it's a closed form model. So we cannot make any adjustments or modifications to the model. In binomial, we have to some flexibility, but not a lot. In Monte Carlo, any kind of assumption can be built in. Monte Carlo is the most flexible model in terms of different scenarios, the conditions to be structured. Black Swords, typically, we will have frameworks built in Microsoft Excel, or we can have online calculators. Lattice models are generally built in Excel if you are building different conditions. If not, we can always use online calculators which are available in the industry. For Monte Carlo simulation, there are proprietary softwares like Crystal Ball, Address that are used by the appraisers to build in different distributions. Some firms may have their in-house Excel models with those distributions built in their Excel tools. I also presented under the formula for black squares. Will not go detail into it. This is more statistical. So these formulas can be used to determine the value of the call option using the 5 key inputs.
Perfect. We have a question. Do you want to take that question first since it talks about Monte Carlo?
Yes, just a second.
So, Michael has a question asking, have you used other distributions than log normal in Monte Carlo? If so, which might be the appropriate?
So within Monte Carlo distributions, we typically use a log and a normal distribution to simulate the stock prices, the revenues of a company, or the profit margins. Those are two standard distributions we may use. So, for example, stock prices cannot be negative. So, in those cases, we may use log normal distribution. However, if we are simulating the profit margin of a company, or in that case, the growth rates for a company, we could use a normal distribution because growth can be positive or negative. We also can use a Bernoulli distribution, which is a yes and no distribution. For example, we are valuing life science company, and it is conducting clinical studies. So it has a drug in phase 2. So there is a probability that the drug may be successful in phase 2, or it may fail in phase 2. So it is more like a yes and no distribution. So if there is a, let's say, 60% probability of the drug being successful in phase 2, we could model that using a Bernoulli distribution, wherein we will run multiple scenarios based on probability of 60% yes and 40%. In some cases, we may also use a triangular distribution. For example, we are companies expecting to raise financing of 10 million to less than $20 million, and the expected value is $15 million. So using the three parameters, we can run a triangular distribution. So all the distribution are used in conjunction with one another and not in isolation. So for example, if let's say in the same example, if the life science company has a successful phase 2 studies, then the stock price may shoot up by a significant percentage. And if it's a failure, the stock price may drop significantly. So those ups and downs can be built in the discrete period using the yes and no distribution. And so we would basically run a distribution until the date wherein the clinical results would be known, and then adjust the stock price for the results of those clinical trials, and then then continue running the simulation for a future period. Michael, does that answer your question?
Yeah, I think it's put on chat, so it does, I think. So maybe you can go to the next slide.
So, and so before we move on, any questions from the audience on the calculation of the different tranches or the breakpoints? Yeah.
I think
So
there's a
Michael,
follow-up point of Michael here.
yes, it's a good question from Michael, and I also agree with Michael that okay, lockdown will not be a good distribution for early stage companies since the distribution not normally distributed. So in those cases, we may end up using a hybrid approach. So for example, we are valuing a early stage tech company or early stage life science company. For example, life science may have a distribution which can be binary in nature, wherein either the company's drug is successful or a failure. So those scenarios can be built using hybrid approach, wherein we can build in independent scenarios that are likely to mimic the future outcome for the company. And for the scenarios which are difficult to forecast, they can be used within the option pricing framework. For example, early stage companies may have a high likelihood of a failure, which will not be captured in an option pricing method. So we may have a discrete scenario that may capture the liquidation or dissolution of a company, and for other events like a change of control or an IPO or going concern can be captured within the option pricing framework. So PM is a blended approach that may consider all the potential future outcomes of a company, and any scenario which has a higher weightage and not reflective within option pricing framework can be captured discretely using a hybrid approach. Now, in terms of the US industry, we have there are like thousands of startups that are raising equity. So there are also scenarios in which we are doing evaluation after the fundraise. So, for example, a company raised Series B financing in December 2023. So we used it as a benchmark to compute the implied equity value as the valuation date. Now, company is required a new valuation as of June 2024. Now, we don't have benchmark transaction. The company is not generating any revenues. And for the foreseeable future, we don't expect any revenues from the company. So now that creates a difficult scenario for an appraiser how to value the company, because there are the traditional approaches like the income or the market approaches cannot be considered due to lack of revenue. We cannot have an asset approach because most of the value would be in the intangible format, which won't be captured within the asset approach. So, so in those cases, we can still use an option pricing method wherein we basically consider the equity value of the company as of the valuation date, as of the financing date, which is December 2023, and then make adjustments to that equity value for a time period between December to June 2024 based on the changes in the market. For example, if the market were favorable, that means there's an uptick in the value of the company because of the market movements. And also factor in the company specific events which we are privy to. So we can make those adjustments to the implied equity value of December 2023 to forecast the implied value as of June 2024 and then do an allocation based on that future date. So that is an approach which appraisers consider to value privately held companies that doesn't have any visibility of generating revenues or cash flows, but still require evaluation, wherein non-traditional approach is not possible to factor in. So appraisers may use an adjusted option pricing approach by making adjustments to the implied equity value of the company. I think we have one more question. Okay. So that is one way in which OPMs can be used. Now, what are the practical challenges of an option pricing method? So, option pricing method also gives a very high weightage to the liquidation rights and preferences of a company. For example, if a company have raised series A and B on a pari paru basis versus raising series B on seniority basis, the distribution of outcomes will change significantly and the value allocated to Series A and B may move significantly in the favor of Series A because it has the first claim to the company along with Series B. So in those scenarios, the value of the security, the value of Series A would be higher if the equation reference is pari passu versus senior to Series B. That said, in the real world of venture capital, investors don't look towards seniority as a means to negotiate. So those kind of scenarios would overstate the value of security under Series A or understate the value of security. For example, when we are doing a valuation with Series B is senior to Series A, that in those cases Series A may be undervalued. So the AICPA came up with a new guidance recently in which you need to value or do the distribution of the value, security or the company's value, assuming all the securities are raised on a pari passu basis. If the investors holding the lead investors has a stake in Series A and Series B, because for them seniority doesn't matter since they have the ownership percentage on both the securities. So in those cases, the guidance prescribes that the appraiser should first value the company, assuming pari passu rights and preferences, estimate implied equity value on the date of transaction, and then allocate the value among the capital structure based on the actual rights and preferences, which is Series B is a senior to Series A, and then apply calibration discount to Series B. So let me take an example to provide more clarity. For example, in our scenario, if Series B and Series A were raised at $9.80 and $7, but if Series B and Series A investors are the one and same, so in that case, the AICPA guidance prescribes that don't run a backsolve to determine the implied equity value based on seniority of Series B and assume that Series B and Series A are pari passu and then run the backsolve. So in those cases, the value of equity would be different compared to the senior Series B, and that equity value which we determined based on the pari passu seniority should be allocated to Series B and Series A as a common stock based on Series B seniority. That will give a appropriate value for Series A because option pricing model generally understates the value when the seniority is built in its allocation. So, any questions on this new guidance? We have, I think, 9 more minutes. Final questions on any of the calculations or
There's one more question in the chat box, Upasak.
so I'll read the question. So Michael has a question to check my understanding. If company's value per stock is between the issue price of Series B and Series A, only Series A and common stock will participate on a higher value compared to the initial issue price. Series B only gets the LP. Correct. So let me clarify. So yeah, so the company's value per stock is between issue price of Series B and Series A. Then Series A and common stock will participate until Series B is LP. So in our case, Series A and common stock will participate until they receive $9.80. This assumes that none of the preferred stock have participation rights, and they are basically that means they are non-participating preferred stock. If the terms of the financing provided participation rights to preferred security, wherein they may receive liquidation preference and then they may participate along with common stock for a residual value. In those scenarios, there is no catch-up for common stock, and the residual value would be allocated based on ownership percentage to Series B and common stock. So those scenarios are called participating preferred stock, which we'll see a lot during tough financing scenarios or current scenarios in which raising venture money is difficult. So venture investors will negotiate for that right, which provides a liquidation preference and equal participation with common stock with no catch-up for common stock. So that financing terms play a major role as to determine the payoff for preferred equity holders, and in this current difficult times, generally the investor will have more negotiating power, so they may negotiate for rights preferences which are beneficial for them. Any friend would like to add to it? So please go ahead.
No, so he's just kind of responding it. So you can go ahead. Are there any other questions, group?
It's Wolfgang. I have one question. Maybe you said something about this, but then I had missed it. As always, for private companies, it's of course difficult to find comparable listed companies when estimating volatility. Do you adjust volatility for example, for different company size or leverage?
Yeah, so it depends on the purpose of the valuation. So if you're able to find companies which are within the same range of equity, we don't adjust for size. But if our company is pretty small, like if our company is at $50 million company or $10 million company, and most of the comparables are $102 billion, then we make adjustment for size. But again, it depends on the appraisers. There is no guidance mentioned in the AICP that requires the appraiser to adjust for size.
Okay, thank you. Do you have a source where you reference to these size adjustments? A risk measure?
Yeah, there's no published guidance on it. So appraisers would have their own ways of adjusting for size. So some of them may look at the size premiums on the Phelps and make adjustments based on the crawl study nowadays. So they may look at the size premiums in call studies, they make use that as a factor to adjust the multiples of comparable companies. In case of volatilities, it's difficult to make a size adjustment. So the guidance would generally mention that use a higher volatility for your subject company if the comparables are large in other big market cap, which implies a lower volatility. So most appraisers would use like a third quartile or higher volatility as an implicit way to adjust for size.
Okay. Okay. Would it be an idea, for example, there is, besides the size premium study of Duff and Phelps Kroll, they also provide such a risk premium study where they split the capital market and the 25 portfolios and rank them by standard deviation of returns.
Correct. There are 25 segments, yes.
Yeah. Would this
Yes.
would this be a source for this standard deviation of returns to look at this adjustment or to adjust to base the adjustment on these standard deviation of returns from this risk premium from this risk study?
We could do that. Typically, we would do that for market multiples or the
Okay.
revenue multiples. But for volatility, it's hard to use that. And if we generally what we would do is we would basically run a linear regression between the market size and the volatility.
Okay.
If that demonstrates the correlation of between the market size and the volatility.
Okay,
And
makes sense. Yeah.
we have observed that in most cases, the correlation is pretty close to zero. That implies that the market size is not driving volatility. And again, it depends in during industry time. Now, if you look at the current market environment, last 2 years were pretty volatile. Even the large the large cap stocks have seen high volatilities, and mid caps were have a very significantly high volatilities. So I think last 6 years has been very volatile given COVID, IPO markets, the public markets. So it's where we have seen very low correlation between the market size and volatility.
Okay, thank you. Good. Any further questions from the audience? No, not more. Yeah, thank you, Upasak, for your presentation and the example. Thanks to the audience. Thanks to Pratik. We wish you a wonderful Christmas time, and we will see us in end of January for our next Around the Valuation World show. Stay safe and see you end of January.
Thank you.
Thank you. Thank you, Upasak.
Thank you,
Thank you,
Pratik.
everyone.
Thank you.